Well, this doesn't explain. Everybody says that this is why gold went down from 2011 to 2015. This is corruption, abject corruption at the highest levels. This isn't just some, JP Morgan prop desk guys trading, spoofing, making a few profits. You're missing the whole picture, man. That's just an itty bitty part of it. Okay. These banks are what we call bullion banks that operate in London. Mike, listen, man, we need this price $8 lower by the end of the day. Can you do that for us? Hey, no problem. I'll take care of it, Boom. Here comes a massive spoof. Here comes a smash where we all sit back and go, wait a second, who in their right mind would sell, 1 million ounces?
Ladies and gentlemen, welcome to the special interview. Today we have a returning guest to the show, Craig Hemke from TF Metals Report. And I got to tell you, you got to go over to tfmetalsreport.com and check out what Craig has to offer, because fundamental analysis doesn't just cut it anymore. Technical analysis doesn't just cut it anymore. What we really need to manage these markets and our positions is analysis of rigged markets, and Craig can bring that to the table as well. Craig, I'd like to thank you for joining me today again on Silver Doctors.
Paul, thank you. I appreciate it. And thanks for the kind words. Reason there is a TF Metals report is the understanding that gold and silver, the digital derivatives market, they're not like anything else, man. When I started pouring my attention into it in 2009, I, like just about anybody else, that's your sole focus. You pretty well figure out pretty quick that man, there's something weird about this stuff.
Yeah.
And then you realize how they're structured. You realize how the banks, in their role as market makers, are supposed to be these benevolent, altruistic organizations, but they're not, man. They're just out to screw everybody. So when you figure that out, you quickly find out that what you're doing is not, as you said, fundamental analysis or technical analysis, actually manipulation analysis. That's what we do. That's why people told me to start a site in 2010. That's what we've been doing ever since.
Well, it's some of the most clear-cut analysis that I've seen, because it is important, because, just over the weekend, Craig, and we'll start off with the JP Morgan scandal or indictment or however we want to call it. But, the manipulation deniers are still out there saying, well, this doesn't account to the extent of the decline since 2011. I mean, can you believe they're still trying to justify this, Craig?
You know what's funny? Well, first of all, I pay zero attention to those people. I mean, and really, frankly, everybody should. I mean, what's the first rule of hole digging, Paul? I mean, you find yourself in one, you stop digging, right?
Yes.
I mean, we talk about collusion. I mean, I would say there's collusion amongst these deniers at this point, because they all sing from the same song. One guy puts out a thing that says, well, this doesn't explain. Everybody says that this is why gold went down from 2011 to 2015. And then suddenly there's like 4 articles like that. Like, whatever. They're all just losers and clowns that they discredit everything else that they do. It's like if you and I were to have a discussion and say, well, the sky's blue. And everybody recognizes now the sky's blue. And then some joker on the internet says, no, actually the sky's red. You go, what?
Yeah.
You wouldn't take them seriously with anything going forward if they are so foolish that they can't even acknowledge that the sky is blue.
Yeah. And the bad part about that is, people pay them money to find out what tone of red it is.
I know, exactly. Well, and I think to some extent, they've held on to this for so long. And for the generalist out there, your little Elliott wave counter, that kind of thing, if they were to admit that any market was manipulated, it would be a logical then step for their subscriber to go, well, wait a second, if all the markets are manipulated, or even if any market is manipulated, then what good is your little wave counting nonsense that you spew? So they have to defend what is an indefensible position. And that's clearly what they're, with a handful of these clowns that are left, that's clearly what they're trying to do.
Yeah.
But anyway, back to your original point. They're saying that, the line now that gets repeated as if there's no collusion between these guys to come up with it. is that, well, yeah, but the metals would have fallen between 11 and 15 regardless. And look, this has been going on. This manipulation of prices has been going on for about as long as any of us can remember, all the way back to 1950s, through the 60s and the gold pool, through the creation of gold futures in 1975. It only got worse as attention started to focus on the metals in the early 2000s. It was prevalent up to 2008. It was prevalent from 2009 to 2011. And again, the period that the Department of Justice is talking about is 2008, 2016. Well, God, anybody remembers what happened on May 1st, 2011, where all of a sudden on a Sunday night, we're carpet bombed for $6 in like 5 minutes. Well, there's a massive spoof right there. And then the CME used it as cover to hike margins 5 times in 9 days, flush out all the speculators that were, any that were long between, 35 and 45. And all of a sudden you're back to 25. And then let's fast forward 19 months. $26 silver holds as support until April of 2013. 1525 holds a support in gold till April of 2013. And then amazingly, those levels are smashed over the course of 2 days. So, I mean, these guys that try to say, well, they spoof in both directions, blah. Yeah, of course they do. That's all part of the bullion banking thing. The desk in New York works hand in glove with the desk in London to manipulate prices either up or down based upon what they need for their physical settlement and what they need for their profit center, their prop desk. And
let's go there for a second, Craig,
okay.
Because, a lot of people are once again looking that, I find the timing interesting. It's in between. We're on the brink of war with Iran, and the Fed's 2-day FOMC is when this indictment gets unsealed. So the timing is quite curious.
The repo thing.
Yes, the repo thing. I want to get to that in a minute. But, everybody's looking to this as, this is it. This is the game changer. Everything's going to be fine from here on out. But you've uncovered some pretty interesting things. And what it does is it ties in this revolving door aspect between Wall Street, Washington, London, the COMEX. Can you explain what your thoughts are on this latest DOJ criminal indictment?
All right. Let me not, if I start talking forever here, Paul, cut me off. All right.
Okay.
Here's the thing. Because I want to start with this game changer idea. Okay. What we're talking here is about JP Morgan, obviously, but it's not just them, right? HSBC, Citi, Morgan Stanley, Goldman Sachs to some extent, Credit Suisse, UBS, not so much anymore, Deutsche Bank, which was kind of the key to setting all this off in 2015 and 16. Okay. What we've got to get is all of the banks out of this business. And until the penalties are severe enough, until the fines are heavy enough as to make it just not worth the trouble anymore, the banks are going to persist and the manipulation is going to persist. Okay. So the idea, anybody out there saying, oh yeah, now the banks are losing control and all this, they're not losing control. Okay. The noteworthy part of this is that the Department of Justice is moving forward under the Racketeering Act, the Rico Act. What's noteworthy about that is that whole statute was put in place to go after the mafia, in the sense that, the kingpin can order Jimmy Two Thumbs to wipe out, Frankie No Knees. Jimmy Two Thumbs goes and does that. But and maybe they get him somewhere or another, but the kingpin lives and Jimmy Two Thumbs just gets replaced. All right. Under the RICO Act, you can go after the mafia, the Don. Okay. And so that's the most significant part of this particular case. And if it gets to the point where the banks say, you know what, why are we even messing with this? We can't make any money at it. We're on the hook for all this physical metal. Now we got all the legal stuff being, let's just get out of this business. Then we'd have something.
And it almost makes me think, what you're saying is, it's kind of like the difference between real interest rates and nominal interest rates, where real interest rates are negative. It's almost like on net, the banks are paying less in the fines than they're making by doing this manipulation. So why would they ever stop if on net, even with paying the fines, are making a profit?
Right. And the bullion banking has to start costing them money too. Because they just rape and pillage the miners, the ones that somehow, for some reason, think that the banks are their friends. They're not. They're not these benevolent, oh, yes, we'll help you through this tough time, Mr. Gold Miner, by letting you sell forward some of your production, and we'll give you some financing. Man, if you're some mining CEO that's still playing that game, you should be forced out as soon as possible. If you're that stupid to not understand how the banks are just gouging you. Anyway, I digress. We need the banks to get out of this business entirely. Probably trending in that direction, and this stuff helps. Okay. But anybody that's, trying to use the clickbait of, the cartel is on the run, and no, they're not. Not yet. Okay. Oh, and Paul, let me just tag this in here too, because I see stuff about how, the price is about to get crushed because open interest is an all-time high, or the commitment of trader structure is an all-time high. Look, it's not a zero-sum game. Yes, both are at all-time highs, but that doesn't mean that they can't go further, right? I mean, the banks are not subject to the same financial pressures as you and I, the hedge funds, and regular speculators. They'll just create more contracts. The only reason we're back to all-time highs is how far they had to go before price rolled over back in 2016. If they need to take open interest to 700,000, if they need to take their net position on the COMEX to 400,000 contracts short, they will. If they need to go to 800,000 and 500,000, they will. They don't have the same margin concerns. They're not constrained.
Right, so because an individual, because a trader or a firm has limited money, they can only do so much. But as a bullion bank, they can just naked short. They can sell paper gold that doesn't exist and as much of it as they want. So it's a waiting game. Am I understanding this correctly, Craig? Right.
So don't go thinking, don't go reading the stuff that, well, open interest is back to where it was in 2016, so we're all doomed, head for the hills. I mean, it's not a good thing, but it's not as if where they took it in 2016 was some line in the sand that beyond which, all the banks die. No, they'll just issue more contracts if they have to and wait for price to roll over and then cover them again. And that's how it worked up through 2011. That's what they'll do going forward. Anyway, back to your original question, which seemed like, hours ago, because, that's how things work. I talk nonstop if you let me.
Well, it's fun talking to you too, so appreciate it.
With the indictments and the corruption, this is a really important thing for people to understand. If you watch shows like Panorama in the UK, or the equivalent is maybe 60 Minutes here in the US, 60 Minutes has done a series of exposés in the last 12 months about people at the Food and Drug Administration who were allegedly supposed to have oversight over the opioid industry, and how Purdue Pharmaceuticals showed up and said, oh, no, man, these things are fine. You can't get addicted to them. And then they cranked out billions of pills. And it's an ongoing, I don't mean to make light of it. This is a terrible thing, right? The people that are addicted and dying on a daily basis and that kind of stuff, okay? Well, what 60 Minutes then exposed is that the lawyers from the FDA have been leaving the FDA, going to private practice lobbying firms and things like that, and then representing.
I knew you were going to take it there, Craig.
The distributors like Cardinal Health, and McKesson and the rest, and they're like, what kind of sick revolving door is this? Okay, well, look, in silver, it's even worse. Even worse. Now, again, nobody's dying, okay? But the corruption is worse. What do I mean by that? A lot of folks in silver recall that there had been an investigation by the CFTC into silver manipulation during the same period that the Department of Justice has now indicted, has looked into, and now it has indicted JP Morgan. 2008 to 2016 is the Department of Justice period. From 2008 to 2013, the CFTC was allegedly, turning over every stone looking for manipulation. In 2013, when faced with irrefutable evidence, even two whistleblowers on the record stating that they had information that JP Morgan was manipulating price, the CFTC closed the investigation, said that they could find no viable reason for prosecuting or finding anyone which apparently the Department of Justice has found viable reasons, but the CFTC couldn't. They closed it and just swept it all under the rug. The head of the enforcement division for the CFTC was a guy by the name of David Meister.
Okay.
2 days after this investigation was squashed and killed in 2013, Meister quits the CFTC. At the time, I thought maybe this cat was just so disgusted that he left in a huff, right? No. Meister then surfaced 90 days later at a Washington legal firm. And now Michael Nowak, the head of gold and physical, gold, silver, precious metals trading for JP Morgan, who has been indicted by the Department of Justice, has retained the one and only David Meister as his lead attorney. So what makes this worse? This would be like if the head of the FDA, the person in charge of approving the drugs, the opioids, suddenly was representing Purdue Pharmaceuticals and all the distributors, because that's basically what Meister is doing. This is corruption, abject corruption at the highest levels. And again, should tell you how rooted, this isn't just some, JP Morgan prop desk guys trading, spoofing, making a few profits to fatten their bonus pools to make sure they're set up in vodka and hookers for the Christmas party. No, this is far deeper, far more ugly than that. And the connection between Meister and Nowak just lays it all out there for everyone to see.
Mm-hmm. I speculated last week that, this Nowak guy knows a lot. So how important is he? That adds a very interesting dynamic. That
I mean, you would sure think next up on the food chain would be Nowak's boss during the period in question, the old Blythe Masters. And then who's Blythe's boss, right? It's Rico.
Yeah.
They've obviously squeezed that Edmonds guy to get all this information, right? Remember, he was convicted back last fall. And they've stayed his sentencing twice as he's, they've got him, like this, and they're squeezing and squeezing, and he's singing and singing. Now, if I'm Nowak, I worry about wiping myself out with a hammer or a nail gun if I'm that guy. The unfortunate incident in a hot tub.
Yes.
Get the Epstein treatment, maybe.
Yes. That's what.
He's finds himself in a rather unenviable position, but we'll see where this goes from here.
Because of his ties to the LBMA too, is that right, Craig?
Sure, yeah, exactly.
Wasn't he like he was just on the board until recently, wasn't he?
Right. Yeah, until last week when they kicked him off because he's indicted a felon at this point. It's a bad look, right? But see, that's the thing. Nowak is the head of precious metals trading for JP Morgan in New York. He's also on the board of the LBMA. And that's what people need to understand. If you're looking at this as just this dot on a screen called gold futures, which trades up and down, and these gnarly monkeys on the JP Morgan trading desk are screwing everybody to fatten their bonus pools, you're missing the whole picture, man. That's just an itty bitty part of it. Okay. These banks are what we call bullion banks that operate in London, delivering the physical metal. London has been the physical metal center now for almost 100 years. And they work hand in glove. The desk in London works with the desk in New York. And maybe the desk in London is on the hook to deliver, you name it, 100,000 ounces of gold to somebody. And they have to do it by a certain date, and they need to get the price down, for whatever reason, all their hedging strategies or whatever. Well, then Mike, listen, man, we need this price $8 lower by the end of the day. Can you do that for us? Hey, no problem. I'll take care of it, Boom. Here comes a massive spoof. Here comes a smash where we all sit back and go, wait a second, who in their right mind would sell 1 million ounces of COMEX futures, at the bid or, or on the offer and just wipe the whole thing out, There you go.
And, one of the things that I've been doing lately, and we can transition this into the repo, because I want to get your thoughts on that. But when I'm writing about this, I'm talking about, the Fed is going in ever since last week, pumping liquidity into the repo market. And basically what they're doing is 24/7 manipulation, market intervention to suppress precious metals. So, I think if we just start talking about this differently in the open, because, everybody cheerleads the Fed for the manipulation, and the same cheerleaders for the Fed are the ones that are saying there's nothing wrong with the gold and silver
Yeah.
markets. So it just boggles the mind.
Yeah, it's an
But,
interesting little dichotomy.
but on the repo, today was like 142 billion, because it wasn't just the overnight repo. They also added the 14-day term structure repo. So, I guess the question is, we've obviously started QE4. The Fed's balance sheet is expanding again. What are you making of this Fed repo market intervention of the last week?
Well, it goes into that global dollar shortage story, that's been percolating now for months. Some people try to extrapolate that to say, well, that means that there's going to be demand for dollars. Dollars going to go up and gold's going to go down, which is just BS. I mean, the dollar's up 2% year to date, gold's up 20. Okay, they are not inversely correlated. That's just a simpleton nonsense generalist idea that gets floated every time gold goes down and the dollar goes up intraday. But it's this repo thing is a function of that. And so the banks they have collateral, if you want to call it that, whether it's treasuries or CMOs.
It's treasuries and mortgage-backed securities. That's
right.
The two of the items on the line.
Right. And so they have collateral, but they don't have cash. And so what a repo is the Fed says, okay, we'll take your treasuries for either overnight or now you save for 2 weeks, and here's some cash in a swap. You don't have to go sell your treasuries. We'll just swap them with you. Here's some cash. And then at some point tomorrow or 2 weeks from now, depending on what the terms are, you give us our cash back and we'll give you, your collateral back to kind of fund those overnight operations or whatever liquidity crisis there is. Well, the problem is that should be a temporary thing. That should be maybe a one bank that might have that issue. And clearly now we're looking at something that might be more systemic. It's not, well, you can see the balance sheet growing. I've seen those charts too, that all of a sudden here comes a balance sheet going back up, right? I'm not sure we can call this permanent QE yet because, they do 75 billion in repo cash. That's expected to be drained right back out when the thing is completed and flipped. So it's not like QE in the sense, these permanent open market operations, of 100 billion a month that we saw back in, 2012 and 13 and the like. But clearly there's an issue here with the banks. Okay. And this whole idea of a dollar shortage. What this means is this, anybody out there still peddling the theory that, well, banks are going to normalize their balance sheets and interest rates are going to go back to normal and blah, it's just garbage. Okay. We are in a hole, kind of like the manipulation deniers, and the banks are going to just keep on digging, and they're going to dig out more and more cash and shovel it out there. And that is revealing the central bankers for the charlatans that they are. I mean, they're just flying by the seats of their pants. They're like reacting, right? They're not actually acting and being proactive. They're just reacting. Oh, put some here, put some cash there, cut rates here, cut rates there, And as that continues, the realization of this sets in and people go, these guys, they don't really know what they're doing. And there's another crisis coming. Give me some gold, give me some silver in all of its forms. And that's what's driving the rally this year. And that's what's going to drive even higher prices next year. So this repo thing is I don't know if it's a crisis yet. And I don't want to call it permanent restart of QE yet, but there is a crisis that's coming and a restart of QE is coming. And so all of this bodes well for us.
The way that you just explained it makes me think of payday lending. And, people get caught up in payday lending.
Or a pawn shop.
Yes, and the Fed is literally the pawn shop right now. And all these banks are caught up in this payday lending. And it's just
it's like the old pawn shop thing with like the 3 lights on a post, right? That symbol. Maybe you can use that symbol with this podcast. That's basically what it is. It's the Fed pawn shop. You come in, you're the druggie or you're just short of cash. I don't want to make it sound like people that use, there's so many people that don't have any cash, that don't even have $400 to spend on an emergency, and they got to come up with cash one way or the other. So I don't want to make it sound like, because these criminal bankers are far worse than just the average. We don't want to put, mischaracterize who they are, but that's a good metaphor though. The bank has some kind of asset. They don't want to sell it. They hope to get it back, but they need liquidity. So they go to the pawn shop, the Fed pawn shop. The Fed then gives them cash and says, okay, well, you can come back in a week, and the only difference is, I guess, is the Fed isn't charging them some, 20% Shylock rate of interest in between. That's about the only difference.
Yeah, because they have to actively suppress the rate. And that's what it said the very first day, last Tuesday. It said, in order to, this was before they cut rates. So it said, then on direct quoting, paraphrasing, it said, in order to help maintain the Fed funds rate between the objective, the target of 2.0 to 2.25.
Right. So this is symptomatic of everything else that's below the surface. The whether it's CNBC and Bloomberg, or whether it's your stockbroker or anybody else that you read that tries to make it sound like, oh, this is really simple. The stock market's doing fine and the economy is okay and all that. No. There's a lot going on that doesn't get discussed. And I would imagine much of this is going to find its way out into the open, even maybe during the fourth quarter.
Now, moving on here, Craig, before I let you go, I got to ask you, because the last time you were on was, let me see here. I think it was, I can't see. I think it was July.
It was a couple months ago.
July 18th, a couple months ago. Craig, you let me down because you said silver was breaking out and we were hitting 1650 and I was getting excited and you were like, now we're not going to be at $18 next week. And sure enough, bring me down to earth. And it was all the way until August 27th before we broke through $18. And I was like, oh man, there it went. Craig just put my candle out right there. So Craig, where is silver going now, and when are we getting there, Craig?
All right. Well, let's tie this to what we've been talking about. Okay. The context in which we had that last discussion was that the banks, particularly JP Morgan, had maintained consistent, brutal resistance at a couple of trend lines and at the 200-week moving average. And all of that was in the area when we spoke between maybe 17 and 18, 16 and a half, 17 and a half. And I thought, man, the banks are never going to, they're just going to keep fighting it and keeping us, wedging us sharper into a deep and deeper corner. Gold would rally. I remember talking at the time, I thought maybe the GSR would go to 100, meaning that gold could go to 1600 and silver could still be stuck at 16. Well, lo and behold, silver took out the first trend line that dated back to October of 2016 in July. Then it took out the 200-week moving average, which had been smashed back from that level consistently since 2000, like 15 times since 2016, and stayed above it. And then finally, the primary trend line, which begins in August of 2013, connects to the July 2016 highs, and then down, was near 1780 or something like that. And we got above there. And whoa, how about this? Really took me by surprise. I was really surprised the banks didn't fight hard. Well, maybe that's because of these indictments. Maybe. You can connect. I'm not saying that's for sure, but the degree to which I was surprised we were able to break through there and make it all the way to 1970 with ease. And now you look back at this, the same time all this stuff was cooking. The indictments maybe were being built or were sealed and not out yet. Maybe there's a connection. Maybe JP Morgan is being forced to stand down a little bit, and now maybe silver is being allowed to rally. Regardless, I think the situation for silver now looks okay. The commitment of trader structure, the open interest, all that stuff is not as bad, if you want to call it that, as gold. Silver is now recovering. It's back above 1850 as you and I speak. Looks like it wants to go back to the previous highs, which are up around 1975. 20 will be a key level. A weekly close above 21 will really get people's attention, because something like 2093 was the intra-week high back in July or August of 2016. So weekly close above that is going to get, just kind of like when gold broke out through 1360 and everybody went, wow, it's been 5 years or 6 years. And then boom, we powered to 1440, and then boom, we went to 1550. Getting above 21 will get a lot of people's attention. And I should point out, we mentioned earlier that smash when 1525 had been a floor and was taken out in April of 2013, and then we plummeted. to 1320 in a matter of days. Well, when gold was holding 1525, silver was holding 26. So now here's gold 1550 or whatever it is.
Mm-hmm.
Silver's still 19.
Yeah.
I think we go through 20, once we get above 21, then the target becomes 26. This is all in line with what I've written about all year, and mentioned is to anybody who would listen. I thought this would be the best year since 2010 because of the reversal of central bank policies and a loss of confidence in the central bankers and a decline in global economy and all that kind of stuff. And here we are, we're up 20% basically in both metals. We're on track to have the best year since 2010. 2011 is going to be even, or 2020 is going to be kind of like 2011 as we move back toward at least all-time highs in gold, up through 26, maybe get back toward 30 in silver. So we're on track. Never going to get there, without some downticks and some corrections. I mean, it's always going to be that way. That's how bull markets work. But I was surprised, and I appreciate you pointing it out. I mean, I thought we would continue to see that GSR go up, but now that we've broken out, you combine that with the news of the indictments, maybe we got a little more open field ahead of us than we think.
Yeah, and in addition, people talk about a lot of the accomplishments in the first 2 years of the Trump administration have been reversing. The GSR was at 64 back in 2017 at the time of the inauguration.
Well,
so that right there is over $20.
There you go. That would work too. So again, it's going to take a lot. There's only going to be a lot for silver to overcome. It can move fast, as everybody knows, but there's still a lot that it has to fight. It's not going to be, we're not going straight back to 48. Mm-hmm. In a period of weeks. At least I wouldn't think we would. But as you move along, though, there's definitely money to be made if somebody wants to try to trade it. The key, like I said, the key level to watch would be a weekly close north of 21. Mm-hmm. That should give you another 25% from there up to 26. Then once you back above 26, then it starts to get really interesting next year.
Nice. So just final thoughts here, Craig. We're moving into the fourth quarter. What is most on your mind? What are some of the things you're going to be looking for just as far as the economy, the markets, politics, or geopolitics? What are some of the things that are on Craig Hemke's radar?
Well, seasonally, this is a good time for the precious metals. A lot of time, October into November is a pretty good time for them to rally. A lot has been made about how the precious metals do from a seasonal perspective in the year before a U.S. presidential election. So there's a lot of that kind of stuff that we've got working in our favor, though the banks will continue to fight us. As we get it deeper into the fourth quarter, the statistics showing the U.S. and the global economy further slowing will sink in. There will be at least one more rate cut, maybe not at the next Fed meeting, but at the one after that. The bond market will be the key thing to watch. We've had this correction in bonds over the, in early part of this month. But I think that's all that was a correction. Interest rates will keep going lower. Mm-hmm. As you correctly pointed out, real interest rates are a big driver. Not only just straight up notional negative rates, but negative real rates are a really big driver for positioning in gold. And I'll just leave you with this, because this is important for people, especially when you look at the sector as a whole. And I can't claim this as an original idea. I got to give credit to Rick Rule because he was the one that gave me these statistics. But over the last 40 years, total global investment allocation to the precious metals in all their forms, whether it's futures contracts, physical metal, the mining shares, whatever, total investment allocation globally has ranged from 8% in 1980 to as little as 0.5% the last couple of years. The mean is 2.5%. Mm-hmm. We just go back to that mean, okay? That's 5 times the amount of global investable assets that will be flooding into the sector than there is now. And there are finite opportunities, places for that money to go. I mean, there's only so many mining companies that make money, exploration, all this kind of stuff. So if the economy slows and all this stuff and QE as we talk about, and as price begins to break out and all these global investment managers start to go, wow, look at that sector, look at gold, the best performing asset class for 2019. I got to get me some of that. And you get this sudden rush, instead of whatever it is, $50 billion, you know, and all these equivalents, it's $250 billion. Prices are going to go higher. And this is a pretty important thing for people to factor into their plans for next year.
Craig Hemke, I'd like to thank you for joining us today on Silver Doctors.
My pleasure, my friend. Let's do it again soon.